Welcome to today's Five with Fitz. I hope you are off to a fabulous start today. You know, I'm looking at the markets today, and we have seen this play so often, we know the lines. Stocks drop on rising fears. All about AI valuations, trumpet CNBC, like they've never seen a growth story before. Wall Street falls big after big banks warn of market pullback, says Reuters, as if big banks and big traders aren't the ones who built the leverage in the first place. And finally, AI leads a stock sell-off sparked by valuation angst, warns Bloomberg. Well, their own AI tools are probably helping short into the dip. In my best Dr. Evil voice. Right. I know that was terrible imitation, but I haven't had enough coffee. The markets aren't crashing. They're just clearing out the ticker tourists, folks. Short-term profit takers are deleveraging by cashing in. The algos are puking positions, and the zero DTE crew is turning otherwise rational traders into a drama disco. So what to do? That's the question. If you're a trader, get busy. You ought to be making money hand over fist today. And if you're not, something's wrong. And if you're an investor, this is great stuff. You've got one heck of an opportunity to make more money. Let me explain. That is always how pullbacks work and why you want to learn to embrace them sooner rather than later. How? Well, by doing two simple things. First, take a hard look at the chart that I've got in a written version of the Five with Fitz today. Stare at it until your eyes bleed. And second, get busy investing in optimism. That's how innovation works. People want to believe that the markets go up all the time, but that is not true, and it's naive to believe that. In fact, the markets require buying and selling to work properly. They zig and zag over time, and there's no alpha, meaning higher return potential, without dips, and there's no opportunity without a little panic thrown in for good measure. Remember this, if you remember one thing about today's Five with Fitz. The markets are the only store on earth where people fear a sale. Here's my playbook. Number one, Palantir sticks it to the popcorn critics again. Now, Palantir outdid themselves again. Revenue plus 63% year over year. It wasn't quite the 70% I thought we might get, but still 63% year over year. U.S. commercial revenue plus 121% year over year. The commercial customer count, or the customer count, grew 45% year over year, achieved a Rule 40 score of 114%, and it raised full year guidance. Meanwhile, you're talking $6.4 billion in cash and equivalent with no debt. Now, CEO Alex Karp said it best during the company's earnings call when it comes to critics. Enjoy, get some popcorn. They're crying. Then in a follow-on interview, he made a comment that had me rolling on the floor. I mean, I couldn't believe it. He called Michael Burry of Big Short fame batch crazy for betting against Palantir and NVIDIA, two of the most significant AI choices on the planet. I couldn't agree more. In fact, I think Burry simply wants to get clear of his positions without looking like a complete idiot. A view, by the way, that CEO Alex Karp himself shares. Now, none of this should be a surprise if you're paying attention. In fact, I told you point blank on national television yesterday and in yesterday's Five with Fitz ahead of earnings that I'd wait to buy Palantir because the Go Fast gang was itching for a fight. Now, I also posted this image, and well, you can't see it here, but an image in the written version of Five with Fitz when it started on Twitter, now X. Just like clockwork, I said, there was a liquidity sweep to the upside and then to the low side. I also gave the OBA family several specific high probability setups yesterday prior to the close, including put options, selling cash secured puts, and even lowball orders, all of which are working nicely this morning as I record this. Personally, I love the puts. I paid $7.15 for a few Palantir puts yesterday prior to the close, and I sold them for $11.25 this morning, a quick 57% gain in less than 24 hours. And if you analyze that, you'll need a considerably bigger calculator. I love this business. Anyway, my point is not to brag. My point is hopefully you made a similar move or moves. The setup was practically screaming opportunity. It doesn't matter. And if you're an OBAer and if you made the trades I suggested or the trading, I suggest you now take a bow and head for the exits as well. Then get busy selling cash secured puts, maybe staging a few lowball orders if something that's of interest or you'd like to do is noted. Heck, even just buying a few extra shares while Palantir is selling lower nicely if that matches up with your risk tolerance, objectives, and circumstances, none of which I know. In investing, I have rented lips. Investing is a lot like boxing. And what I mean by that is that the best boxers, like the best investors, often use combinations that lesser fighters don't see coming because it helps them be devastatingly effective and win. Hoo-yah! Keith's investing tip in this department is really simple and very powerful. It's a lesson I learned a long time ago. Many people want instant satisfaction, but the real profit potential comes from building wealth and knowledge consistently over time and using what you learn as you learn. If you don't know how to do something like the tactics I've alluded to today that the OBA family uses, that's a totally fixable problem. So learn, dang it. I am not the sharpest tool in the shed, and if I can learn, you can learn too. Number 2, Uber rocks but still has a robo-taxi problem, in my humble opinion. Uber reported Q3 earnings, and you know what? The numbers are pretty darn good. Revenue, $13.47 billion. That's plus 20%, give or take. Beat expectations. Gross bookings, $49.7 billion versus $48.7 billion, 7.4 versus 7.3 billion expected. Q4 forecast, $52.25 billion. 53.75 expected. So, I think we're pretty good. Delivery sales plus 29%. Free cash flow 2.4 billion versus 2.5 in the guidance range. So these are good numbers, right? They're not great, but they're good. And my concern is what happens when Tesla fully gets robotaxi up and running. That's the real problem here for Uber. I said in September earlier this year that I think Uber is a $50 stock a year from now, barring some truly earth-shattering, game-changing changes to its business model. That still stands. I might be wrong, but it works for me. Putskis, short or avoid. Number 3, but of course they did. Norway's wealth fund is opposing Musk's pay deal. Nothing says fiduciary duty like micromanaging the guy who turned $6.5 billion investment into $1.5 trillion, while many were busy perfecting their fantasy football lineups. While we appreciate, and this is a quote, while we appreciate the significant value created under Mr. Musk's visionary role, we are concerned about the total size of the award dilution and the lack of mitigation of key person risk. It's consistent with our views on executive compensation, says Norges Bank Investment Management on its website, right? Really, what that really means to me when I read this is, quote, we're terrified of big numbers and even bigger results. So let's pretend spreadsheets are more important than spaceships. Yeah, it makes my brain explode as an investor. Tell me again how opposing the one CEO on the planet who's delivered 23,000% return since 2018 is protecting shareholder value. I mean, seriously, last time I checked, Norway's fund owns 1.7% of Tesla, roughly $25 billion in profits, courtesy of Elon's key person risk. I mean, there you go. So everybody in Norway, on the executive committee, how about you send him a fruit basket instead of a participation trophy for mediocrity? Love him or hate him, Musk has created more wealth for more shareholders than any other suit in the history of suits, at least in my humble opinion anyway. Meanwhile, the bureaucrats in Oslo are evidently busy counting paper clips and polishing their moral high horse. So here's a newsflash, geniuses. If you want boring returns and no dilution risk, buy bonds. If you want to change the world and your portfolio, quit whining and let the man do his thing. I'm just saying. Now, Keith's investing tip. If you don't like Tesla or you can't get past Musk himself for whatever reason, that is totally cool and totally okay. Not every stock is suitable for every investor. Just be sure to find another stock with Tesla-like potential. And yes, they are out there. In fact, history suggests there are 10 to 15 Teslas out there right now in various stages of maturity. So don't dally, though. I mean, the AI train is very much leaving the station, and you don't want to get left on the platform any more than I do. Number 4 today, Kenvue gets a bid, deal or no deal. Well, Kimberly-Clark says that it'll buy Kenvue for $48.7 billion in a cash and stock deal, creating a consumer staples giant spanning Huggies, Kleenex, Band-Aid, and Tylenol. Time to buy? Well, respectfully, if that's your idea of growth and you like watching two legacy companies high-five each other over yesterday's staples, well, the FDA sharpens its acetaminophen pitchfork, and go ahead. Kenvue's brand portfolio and margins are solid, right? They have been for a long time, and they're probably going to stay that way. But the narrative risk hasn't gone away, especially with lingering acetaminophen headlines and residual J&J adjacent liability optics. Now, that's a mouthful, but my point is this. You might be buying a front row seat at the penalty box tour a la Altria and Bayer for a decade of sideways trading. So do take that into consideration if you want to buy. My POV, Kenvue is still very much an N+1 company, meaning a business that's tweaking the status quo, not inventing the future. I would rather own businesses that are creating the future, innovative therapies, real pipeline, sticky recurring revenue, than pay up for yesterday's brands packaged as value. Now, if you need help separating the wheat from the chaff, I'll be here, and I'd love to see you on board. And finally, number 5, Starbucks is partnering its way out of China. I almost didn't know what to do with this one. This is astonishing. I spent a lot of time in mainland China over the years, so I've seen this firsthand, and it I mean, almost speechless, and it takes a lot to make me that way. But the Starbucks just inked the $4 billion joint venture with Boyu Capital, handing over 60% of the control of its China operations while keeping 40% in licensing rights. Now, they're calling it unlocking value, or, it should be unblocking value, but, either way, right. China is a brutal market. Pandemic hangovers, a sluggish economy, if you believe the headlines. I don't think it really is, but if you believe the headlines, and that's the story. And then there's Luckin Coffee, which is eating Starbucks lunch with cheaper brews, tastier coffee, and friendlier baristas. Traffic's up, sure, but only because they've been discounting like crazy. So trade idea is the same as before. Put skis short and avoid, unless management finds a way to make the coffee taste better than the latest press releases. Oof, harsh, I know. But that's Starbucks for you. Anyway, today's bottom line. Many people swear up, down, and sideways that they'll take action whenever there's a sell-off or correction, only to chicken out when the time comes. That is normal, and it's totally fixable. Remember, the strong feed when the meek retreat. So, if you want better investment results, be strong. Simple as that. You got this, I promise. And as always, let's make it a great day. I look forward to seeing you tomorrow. Thanks for watching. Cheers.